Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Andy Baehr, Managing Director at CoinDesk Indices. We have Kean Gilbert, Institutional Relations Contributor at Lido DAO, John Motzel, Head of US at Kaiko, and Stani Kulechov, Founder of Aave Labs. We are here to discuss the latest in the crypto space and the rationale behind integrating RWAs and the potential impact on both DeFi and TradFi systems. It is great to have all of you back with us, as always. Andy, let's go around the horn here first, starting with you, CoinDesk Indices. You've had a lot going on there. Quick overview of where you are in the digital asset space.
Yeah, and it's a wet blanket moment in the markets right now. Let's get the bad news out of the way, and then we can start talking about the stuff that's being built here. Right, the markets have been soft in the 2 months since the inauguration. The price of Bitcoin has found support around 80,000, but it used to have support around 90,000, support at 100,000 before that. 19 out of the 20 CoinDesk 20 names are down on the year. So the market feels very struggly. It feels a little bit like last summer, where you couldn't really find an instance of positive support or catalyst for uptrend. So we'll acknowledge that for now. Right. These market conditions usually last a quarter, and then there's another catalyst to go up. But the amazing thing is that in this, money isn't off-ramping into fiat. Money is sidelining into stable coins and to tokenized real-world assets. And that's really the exciting part. 230 billion of stable coins, and CoinDesk just published a story that the tokenized money market and short-term treasury funds are up to 4.2 billion. So that shows commitment into on-chain assets, and the great panel here is well tuned to talk about that.
Which is interesting because it makes you think of, it kind of sounds like equities for a moment. There's a lot of cash on the sidelines.
Right.
No one's retreating. So, exercise a little bit of patience there. Tell us, Kean, Lido DAO, the work that you're doing there and this trajectory with RWAs.
Yeah, it's exciting times. Like from a Lido perspective, the focus is really on staking, and I think that can play a critical part from an RWA perspective, especially when RWAs have the potential to get yield.
Yeah, it certainly does. And let's talk about this a little bit more, John, from Kaiko's point of view. Staking, we're hearing a lot of that term lately. Why is this the exciting moment when you think about RWAs, what's happening with tokenization, how this is helping to integrate the TradFi and DeFi spaces?
Well, it's a very popular topic. Our focus has always been on institutionalized market data, but when you're institutionalizing these products, these DeFi-related products, you find that cross-section of TradFi and DeFi, and the staked assets are a very fresh idea to the ETF and ETP market that will definitely get a lot of entrance. Yeah,
and that's kind of always been the ethos behind Aave Labs, Stani, right? Is that institutional focus in helping to foster the adoption there?
Yeah, exactly. I think we've seen a lot of growth in decentralized finance, and we had, for example, 35 billion net deposits in the Aave protocol, which is a decentralized infrastructure. Which a lot of that is stable coins, and that interest is just growing, and more recently, I think, because of the RWAs and the concept of tokenization, we're seeing more interest from institutions to actually tokenize traditional assets, bring them on chain, and then plugging into decentralized finance. So basically using these resilient protocols in the back end while bringing their own offerings on chain, and I think that's a trend that is going to keep growing.
Let's talk about the Horizon initiative here and what you're doing to address the current challenges that deter institutions from participating in DeFi.
Yeah, I think the main thing about Horizon is that DeFi is permissionless. It's open liquidity network, essentially. And Horizon, which is a Aave Labs initiative, what we want to achieve is you can have these permissioned RWA assets while you're borrowing permissionless stablecoins. So it opens up the doors for collateralization, where you can use RWAs as a collateral, such as the treasury bills and money market funds as a collateral and borrowing against, and provides this treasury management tools for a lot of these institutional customers. And there's that demand at the moment, and Horizon is there to fulfill it.
Yeah, and TradFi integration, when you think about it, Kean, these staking solutions are helping this integration to be more familiar to TradFi.
So we're really kind of building this ecosystem. So I think a big part of that is obviously at the custodian level, and making it as easy as possible for institutions to stake is critical. And you've probably seen a lot of developments right now where these big asset managers and banks are enabling custody support for staked assets.
Yeah, and that sounds familiar to TradFi. I think custody really was that roadblock before you could, move forward.
Absolutely, it's definitely at the foundation level. And I think ultimately a big part of it is this capital efficiency piece. Like people love staking and institutions love staking. They're not just going to park their ETH, for example. Obviously they're getting exposure to the price of the asset, but from a capital efficiency perspective, being able to stake it, getting 3%, it's terrific.
Yeah, it really is. And John, it feels as if, as this infrastructure is evolving, and I think that's the exciting part about the conversation, in addition to staking these products that are being derived off of it, this is going to be the place where liquidity starts to really, that's going to be the source of it, as you start to see more RWAs and tokenization pick up speed.
Yeah, and we need to be patient too.
Right.
I was saying earlier that to my friends here that the crypto and the distributed ledger world has the unique benefit of having something that self-funds it, and that is crypto assets. And as we start venturing more onto the RWA landscape, there are a lot of companies that can fund their research and their R&D on the backs of crypto research. So Kaiko, we've been in the market for 10 years now on the backs of institutional grade crypto market data. However, our goal is to advance the broader digital asset ecosystem. So not everything has to be around crypto, it's around the rails that play the pivotal role in this industry.
Right, and Andy, you and I talk about this all the time. It's not necessarily the movement or the fun new shiny things that come out that excites me. This to me sounds like market infrastructure evolving.
Totally, it's exactly right, and we've talked about it at this table a couple of times now. So much of crypto was started with retail in people's basements and then got adopted up. This feels like the first thing where, hey, how do I make sure my collateral is enhanced? How do I make sure I want to keep my assets on chain? I don't want to move out of fiat. I want to make sure that I can get the staking rate for ETH, but in a way that I'm not doing it myself in my kitchen, that it's being done professionally and at scale. And if I want to park in stable coins, well, I don't want to accept that I'm going to have no yield against that. So this is really the institutional way coming down for collateral management, for sidelines, for sidelines holdings. It really is going to invite more and more asset managers and asset owners into the space because they can have, sort of non-risk assets that are yield bearing, or ETH assets if they want to store an ETH that's yield bearing. These institutional solutions are crucial. It's probably the thing, this and the semi-permissioned blockchains that allow certain peeking into whose collateral is moving where. These kind of things are critically important, and it's this kind of plumbing that very few people see, but it's so important to invite new people into the market.
Stani, do you think that's a function of interoperability improving, that this is helping to foster the evolution of the infrastructure?
Yeah, I think basically we don't see only new financial products, but we also see kind of the financial infrastructure to progress. So we started ages ago with clayboards, we moved to paper, we moved to digital, and now we're moving on-chain. And what it actually means is that we have more certainty on transactions because they are secured by programmable code like smart contracts, and you have more transparency. So you can audit the system like decentralized finance across the whole ecosystem. And I think that's really powerful for composability perspective.
And that's what is exciting to me with Horizon. The core of my coverage is data governance and cybersecurity, and now we're hearing terms like compliance and governance, continuous compliance, and thinking about risk management as a forethought and not something beyond it. I think it's exciting how those challenges are being addressed in a more structured and compliant way.
Yeah, and I think Horizon basically combines both of these worlds. So you have that DeFi infrastructure with smart contracts, auditability, but at the same time, you have the more traditional ways of handling, for example, KYC, compliance, and all the institutional requirements. And it's basically a hybrid of two different worlds, and best of these two worlds.
And speaking of data governance, you had said, Kaiko, one of the things that you focus on is market data. It's the commodity these days. How crucial is it that your data is structured, it's clean?
It's always been, data's always been important for all financial markets, but now it actually becomes a pivotal role in the execution of products when we're talking about tokenization. So market data or data has always just been a reference for the settlement of these financial instruments, and now we're getting the unique opportunity to actually feed data into these smart contracts to execute these financial products. So it's not just a reference point that we can use for research and backtesting. We're actually using data to feed into these smart contracts to fuel the industry.
Right, and speaking of product and market innovation, these staked ETPs, will it have the same look and feel and function as as we know it with ETFs?
I think so. Like the exciting part around staked ETPs, staked ETPs is obviously the capital efficiency piece. But one thing from a Lido liquid staking perspective is unlocking the final part that's unstaked. So for example, in Europe, there's a number of different staking products already, but they're capped at kind of 50 to 60% staked. And the reason for that is they have to deal with redemption requests. So if you were to use, say, a Lido staked ETH, given that ETH is highly liquid, you can actually go from 60% staked 90 to 100%. And I think that's what we kind of envision from a US perspective in the future, where staked ETFs.
Is there one product that's favored over the other? You know, I know you brought up ETH a number of times. How's the market approaching it in terms of how they're selecting the structure?
I think for a lot of institutions today, they're going to place bets. And I think if you're going to place a bet, from my perspective, you're always going to place a bet on the biggest ecosystem with the most developers. I think that still is ETH today. I think the Ethereum Foundation has obviously gone through challenges and developments. You have terrific work happening now with the Enterprise Ethereum Alliance and Etherealize. And I think like ETH is here to stay.
Yeah. I mean, the asset class is so young.
Yeah.
It's so young. What are we talking, 15, 16?
Yeah, even less. Yeah.
Yeah, I mean, relative to equities in the bond market. Andy, speaking of product innovation, I think what the potential in the indexing space is so exciting.
It is exciting. I was just at lunch before this and agreeing that ETH is here to stay, but ETH is not always going to be understood. ETH's competitors are not always going to be understood. The staking yield and what it is it a utility yield? Is it dividend-like? I think many investors can benefit, just like they did with tech stocks in this room 25 years ago, right? They'll appreciate the trend towards the future, and they'll appreciate that technology is going to lift things, but picking individual names and picking individual timing remains something that many people should not do, right?
Yeah.
So we like, of course, indexing, as of course Kaiko does as well. We like this idea of coming up with baskets that represent the future. Those baskets, though, should have advantage of things like a staking yield, and if regulators go token by token approval-wise, they can miss something like staked ETH as a separate token that is really just yield on top of another token. So we have to evolve out of that kind of narrow mindset. But then that whole market structure doesn't work super efficiently unless stablecoins work in such a way that they can bear yield in a way that's comfortable for everybody. So all of these pieces are critical, and that's just for the retail market and putting products together. The OTC market, which has to trade this and create liquidity and sort of be like the investment banking layer of crypto, that has to handle KYC and collateral management and counterparty management, credit, all the back office, all this plumbing stuff. So a lot of that still has to be built, and yes, it's super early. For most investors, they will be glad that they learned about stuff this early, but betting on the whole asset class, we feel, having Bitcoin as a store of value and betting on the rest of the asset class as the future of finance, really as a whole is, we feel, the way to go.
Right, but that's an important distinction to make. You have to know who your audience is, not just within the digital asset space, but that's any space. Going back to the cyber example before, right? I mean, there's a way that you talk, you discuss these needs with your board, with the sales and product lines, with risk management, with your CFO. It's the same thing in digital assets as well. Understanding who your audience is, being able to effectively communicate that. I wouldn't approach it in any other way, would you?
I would not.
Yeah.
No.
Yeah. So tell us more about the the innovation around indexing with Kaiko. What's going on?
Well, so the unique part about the indexing space is you're trying to get ahead of what the market's actually asking for. So there's a lot of great ideas floating around, but there needs to be also generally demand for those products, not just on the ETF or index side, but in the underlying market. So some of the difficulty is with some of these assets, there is a lot of liquidity, but for other assets, we're still growing those markets. And you need to have more liquidity on these markets to build indexing, to actually have more flow and to have hedge funds actually enter into the markets to acquire these ETFs. I think comparison is the thief of joy. And my one concern is everybody's going to compare indexes or maybe even staked ETFs to Bitcoin ETF. Like, that's comparison the thief of joy, and just because it's not living up to just Bitcoin straight ETF doesn't mean it's not successful.
But doesn't that go back to Andy's point where there's two different functions? There's a purpose for Bitcoin and there's a purpose for other digital assets.
Yeah, and the problem is sometimes they get blended in the market, and the idea is just one single idea, crypto ETFs or crypto indexing. But we're all educating the market that these are unique, distinct products, and that everybody should view them that way.
It's like saying, Stani, the tech space. There's cyber, there's communication services, there's the hardware, the software. I mean, there are distinctions within the asset class or within the sector itself. I just think it's
and it's
maturing.
a spectrum. So for example, even like decentralized finance is a wide spectrum. So obviously there is different types of a protocol. It's an open space, so there's a lot of innovation and also in the blockchain space in general. So I think being able to be granular and educate a lot of the audiences is going to be a very important part of this.
Do the yields or staking yields that you've been discussing, do they fluctuate? Is there any correlation to what's happening within the macro environment as we think about interest rates, kind of, contextualize this a bit?
Yeah, I think overall in decentralized finance, the rate follow kind of like a similar market dynamics, and they're very driven of the wider crypto ecosystem. So when there's more demand for stable coins to finance different kinds of goals, you see rate spikes, and then there's times when demand is going down as well. So there is that type of market-driven interest rate going on. But there's also things like the Aave native stablecoin Go, which is essentially providing predictable yields for predictable borrowing costs for the borrowers. So there is already primitives where you don't have only the market rate, but also you are seeing more fixed yields and also fixed borrowing costs that derive from the market, what brings more predictability for depositors or, for example, borrowers as well.
Yeah, well, I mean, borrowing costs, Andy, I don't have to tell you about that. I mean, it might not even make sense to do the trade sometimes.
No, I know. And a lot of this springs from how hard it is to get banked and how hard it has been to get banked as a crypto firm, and the innovation that's saying, okay, you're not going to bank us, we're going to stay on stables, but we need some yield. How are we going to get the yield? Okay, we're going to set up we're going to make use of a decentralized borrowing and lending market. Okay, well, we need fixed rates. Okay, well, that's going to take some time. In the meantime, we might as well be staking our ETH and getting 3% there. And those rates have been extremely stable. We would like to see them fluctuate a little bit more with activity, but still very stable with a core base, very easy to understand, programmatic, a simple formula. So you're seeing the beginnings of a necessarily unbanked banking system, an unmoney marketed money market system that's fascinating, very institutional. I think for retail people who are thinking about the space, all of this stuff has to settle to a blockchain. So even if you don't know about this, you haven't worked at a bank, you don't understand what collateral management means, a lot of this is going to settle on Ethereum or other layer 1 blockchains, and that's going to grow. So maybe you don't want to pick Ether versus Solana or versus Avalanche or another, but certainly understand that these blockchains are going to be used. And that's just for settling these financial things. Forget about settling the contracts and KYC and all the other kind of non-financial things that the smart contract platforms will do. So,
which is interesting because it sounds as if the staking and the yield rates that you're talking about are more stable than the underlying.
Oh, for sure.
Which is a little bit.
And you know what? That's what makes them a little bit, I hate to say this, a little bit boring, right? They fluctuate at times, and when a new thing becomes borrowable or lendable, you have these giant kind of J-curve kind of lending rates that are teaser rates to get people involved. But yes, the ETH staking rate has fluctuated between 3 and 3.5% with only a few exceptions for the last year, right? That's really boring unless you're posting ETH as collateral for something for a year, in which case it's an enhancement that you would almost never not do, right?
Right. Some sort of covered call overlay.
Absolutely. When you're posting something and you're committed to having a certain position, whether it's in a stable coin or an ETH, you are very quickly going to get to the point where, of course, I'm going to take that yield, and of course, I'm going to lend on Aave, or of course, I'm going to stake my ETH, and I want to do it professionally. What's the best way to do it? Do I need liquidity? Do I not? How can I optimize? What kind of risks am I taking? Am I lending party to party, or am I lending into the protocol? These are all great conversations to have, right? So now when we have these risk-off moments where people sideline but don't off-ramp, right? A lot of smart demand side is coming in and saying, we need to do this better. And RWA is, of course, the third way, right? I'm going to actually take some treasuries, put them into a token, and I'm going to give you that, right? So this is, I think, one of the most exciting innovations over the last 12 months that we've seen really blossom. And can you imagine 4.2 billion versus what must have been peanuts a year ago? Imagine 1 year, 2 years from now.
Yeah. So, Kean, what I'm hearing is this is classical risk management.
Yeah,
when you're able, when you have predictable yield and income.
Yeah, but like to Andy's point, like staking getting 3%, or native staking, I should say, getting 3% is terrific, but it's not that exciting. And that's kind of where liquid staking comes in. This idea of you stake your ETH, you're giving STETH in return. You can then take that STETH, deploy it into DeFi, or use as collateral on a centralized exchange. That's where it can suddenly get quite exciting. And again, from a risk management perspective, that offers a lot. Like if there's suddenly a black swan event, if you're natively staking your ETH, there's a queue to get out. And of course, if things are bad, that queue tends to increase. Where if you use something like a liquid stake token like Steth, you can instantly sell that Steth for USDC. So from a risk management perspective, that offers a lot.
Yeah, it sounds very institutional in my mind. I mean, now you're thinking about portfolio management and you have options, you know, along with that, meaning there's something for everyone. If you want something a little bit more stable and a little bit more boring, just like, you know, consistent income, that works for some investors.
Yeah, most are looking for the basis trade, but I do like what Kean was mentioning. If you want something, boring isn't bad. Boring can be good, but it doesn't have to be boring either. And the idea of a staked asset coming outside of institutional and more broadly across the market, we can open up some of these more exciting yields to the broader masses. It doesn't have to be just for a small subset of the market.
Yeah. All right, and Stani, in the last 30 seconds here, when you think about the work that Horizon's doing and the longer term sustainability and what this, you know, could look like, let's call it in a year from now, what do you think the landscape looks like?
Well, I think the crypto native assets will still keep growing, so that's going to be a trend, and DeFi will grow as well with that trend. But I think what will happen is that at some point stablecoins will actually increase in market capitalization over the crypto native assets, and then tokenized assets, the RWAs, will increase even further in market capitalization. So I think a lot of things that are in the traditional finance, in terms of financial assets, they will simply move on chain, and then they will be accessible in DeFi and elsewhere. Yeah,
well, this was a productive conversation despite, you know, the noise in the headlines, which I think shows that the asset class continues to mature. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.